Hello, viewers. Welcome back to part two of Fundamentals of Accounting. In the previous part, we understood the evolution of accounting, and also we had a brief understanding about the requirement of bookkeeping, how the transactions are captured, and how financial statements are produced by maintaining of our books of account. And also, in the previous part, we understood about the purpose of this financial statement and how it is going to help the business and also various other stakeholders who are interested in your financial statement. The other stakeholders could be your investors or your shareholders, and also the compliance requirement need a financial statement that needs to be submitted on a periodic basis. So, in this part, we will get into the first of the financial statement, which is the balance sheet. So, we will understand in this part that what is a balance sheet, what constitutes balance sheet, and what are the components are there in each of the parts of the balance sheet. Now, the name balance sheet itself suggests that this is a report which is going to produce the balances of some accounts. And what are those accounts which are reported in this balance sheet is what we will look into it. Now, one thing, if you have noticed, our financial statement has two parts to it. One is the balance sheet, the other one is the profit and loss account. Now, if you have noticed, the balance sheet basically reports saying that balance sheet of a company, it says as on. Generally, a financial statement is more relevant when you are extracting that information at the end of the financial year. So if you see, it says balance sheet as on, or it says balance sheet as at 31st of March of a particular financial year. At the same time, if you now see the profit and loss account, the statement starts profit and loss account for the year ended so and so. So what do we understand from this? So like the name suggests, the balance sheet is basically going to give you the information of the position of your company as on a particular date. But whereas the profit and loss account is the summation of your operations, of your income related activities and expenditure related activities for a given period. So the period that we saw in the previous part, we spoke about the accounting cycle and the financial year, which is a 12-month period. So in this last 12 months, what is the activities that you have done, and what result of the activity is what gets reflected in your profit and loss account. So balance sheet, basically, if you see, balance sheet constitutes two sides to the statement. So one is basically the asset part, and the other one is the liability part. So why do you need these two different sides? Is basically because of our double entry system of accounting. So we saw in the introduction that every account or every transaction has got two impacts. One is the impact on the debit side of the books of account, and the other one is the impact on the credit side of the books of account, right? So that is why every statement or every transaction has got two sides, debit and credit. So we will understand this debit, credit, and all those aspects as we move forward. So if you take the balance sheet has got two primary group which gets reported here. So the one is the asset and the other one is the liability. So first, let us try and understand what do you mean by asset. In a layman's term or in a simple language, if you see, asset are those accounts or those ledgers from an accounting point of view, or those accounts which the company owns. So anything the company owns becomes part of the asset of the organization. So at the same time, how do you define a liability? A liability, again, in simple terms, a liability are those things which the company owes to somebody. So that's the broad distinction between an asset and a liability. So let's see what the balance sheet is all about. So a balance sheet is a statement prepared to measure the exact financial position of a business on a particular day. So what do we understand by this? See, when you see a balance sheet, if you are seeing a balance sheet, let's say on 31st of March of any financial year, and that is the position of your asset and liability. So these are the balance sheet is going to tell you these are the assets that you are holding as on this particular date, and these are the liabilities that you own as on this particular date, right? And the very next day, if there is any transaction that is happening in your organization, then the position of your balance sheet will not be the same as on the previous day. So that is why generally an balance sheet is stated as balance as on a particular date, right? So first we will see the liability part, which we understood that the liabilities are which the businesses need to owe somebody, right? So what is the liability? So again, obligation or debts payable by the enterprises in the form of money, goods, or services, right? So the first of the liability is equity or capital. So, in case of a, private limited company and public limited company, the capital is called as equity, and generally, in case of a proprietorship company or partnership company, it is called as the capital of the proprietor or capital of the partners. Now, some of you might be surprised or wondering, I am starting my business. I am investing my money in my business. And why this money that I invest in my business is a liability for the organization? This is the most important or the first step in understanding the fundamentals of accounting. So, the first thing that we have to bear in our mind is that we have to consider business as a separate entity and the promoters or the owner or the shareholder as a different entity. That is the reason why every company says capital introduced by the owners of the business is a liability to the business, or it's a liability to that particular entity, or it's a liability to that particular organization. So that the first liability for the business is the capital that is introduced by the owners. Okay, so that's basically the liability. Now, uh, another important thing that you have to keep in mind, especially when you are maintaining books of account, is that every transaction that you are interpreting uh, for a business, you have to consider those transactions from the viewpoint of a business. So which means, what happens to the business, you as a business, what is the impact of the transaction is what you need to start analyzing them. Only then you will have a proper books of account maintained. Don't mix up with the, especially in case of capital, because I've seen in many of my sessions when I used to conduct for during the college sessions, and also during my various other sessions for freshers. Okay, so the first question I ask them is that capital introduced by the owner, whether it is an asset or a liability. 30 to 40% of them, they say capital is introduced by the owner, so it has to be the asset. So probably now you understand why a capital is a liability for a business, right? So why do we invest capital? See, the overall objective we have understood. So the money is invested in the business for what? It's basically for earning profit through having better income and having a curtailed and reasonable expenses to manage and maintain your business successfully, or operate your business successfully. So the primary aim is to make profit, where it has to generate income in the organization. Then the second block of liability is your loans and borrowings. So these loans and borrowings are, generally you take a loan from a bank, from a financial institution, or sometimes you might be having loans or borrowings from your friends or relatives or any such other person, right? So the second part of liability is the second block. So I will also tell you why these thing information have to be classified or segregated into a logical block. Okay, so the loans and borrowings basically are another set of liability that the company needs to owe, right? And for example, if you see, you might be having an OD account. OD stands for overdraft account, or you might be having a facility of OCC account. So OCC is also kind of a overdraft, but then there is a slight variation between the OD and the OCC. Now OCC stands for open cash credit, right? So I will discuss about the differentiation between an OD account and a OCC account. Okay, and we will see what are the other kinds of liabilities which are there. Okay, generally, like I mentioned, generally, the loans and borrowings are predominantly, largely taken from the banks or financial institution. The loans are taken again with the intention of making income, right? And the third set of uh, liability that gets reported in the balance sheet is your current liability. Again, the word current itself is an indication that these are the liabilities which are current in nature, which means basically this takes the priority over paying back the money or the goods or the services which we saw as a definition of liability in a shorter period of time. Okay, so the debts are obligations payable in a short time. So what is this short term? How do you determine the periodicity of this short term? See, generally businesses consider a short term liability which are generally within a period of 12 months. That's the normal standard that you apply. Now again, there is no hard and fast rule, right? So basically it is a proper way of reporting or representing your liability as a current asset. Whichever liability needs to be cleared off within a shorter period, which is generally within 12 months period, is what gets classified under this current liability. So what are the different kind of current liabilities that can be classified under here? And also let us try and understand what could be the other kind of liabilities which is current in nature, which needs to be cleared off within a shorter period of time, right? So if you see, let's just go back. If you see capital and equity, it's a liability of the organization, but generally capital is not paid back in whole, at least within a shorter period of time. So because the moment, as a owner, if I am, start withdrawing capital, then I will not have enough working capital, and then I will not be in a position to run my business successfully, right? So the last liability the business needs to clear off is the equity or capital, right? Then comes your second stage of liability, which is a longer term liability, which are the loans that you take from your bank. Okay, one kind of loan is basically, it could be a term loan, where probably you might have taken loan for buying of capital equipments, machineries, and maybe vehicle, other things for your business purpose. Now these loans, generally the liability or the obligation to clear of this spans over a period of multiple financial year. For example, you take a capital equipment loan. Generally the loan, we basically call this as a term loan, and the term loan generally extends to a period of maybe 3 to 7 years or 3 to 10 years. So that means over a period of 3 to 7 or 10 years, you're going to clear off this liability in parts, uh, to the bank or the financial institution. So this is a long term liability, right? And the third one is the current liability, which is the shorter one. Now let's now try and understand the OD facility and the OCC facility. Okay, first let us take the OD facility. What is OD? Overdraft facility is basically depending on your organization's balance sheet position, and also maybe because of your credit worthiness in the market and various other, considering various other factors. Generally you would want an additional working capital. So generally the OD facility is used for managing your working capital on an ongoing basis. So OD facility is over and above the balance in your account. So if you see, first is that every business are going to have a current account, right? So we know that there are two types of accounts in a bank. One is the savings bank, that is the SP account, and the other one is a current account. So saving banks generally is opened by an individual, right? And no company can have a savings bank account opened. So it's a current account. So what is the difference between savings bank and the current account? See, in a savings bank, again, the terminology itself is an indication that this is an account where you open in the bank to save your excess fund that you have with you in a safer place. So there are restrictions in the savings bank account, like you cannot withdraw money beyond a stipulated number of times in a given month or in a given period, right? And there is a small benefit that you get by way of interest for the money that you park in the bank. So the banks are going to use that money for lending to somebody, and they are going to earn out of it. So the portion of the uh, income that the banks earn will pass on to you by way of interest for the money that is lying in your account, right? But whereas the current account, a current account where there is no restriction, and the current account will not carry any interest. Whether you have 1000 rupees in the current account or 1 lakh rupees in the current account, over a period of time, no interest is earned, right? But the advantage of current account is on a daily basis, you can withdraw any number of times or you can deposit amount any number of times. So there is no restriction. So it's an ideal account that the banks will allow the businesses, or as a mandate is the current account. So now, whatever is the money that is lying in your account, in your company's name, that much, to that extent, you can keep withdrawing or you can keep depositing additional fund into that particular account. So the moment your balance in your current account becomes zero, you cannot overdraw beyond that, right? So that is where the facility of overdraft is allowed for businesses based on various criterias and conditions, if the businesses are able to satisfy to the requirement of the banking norms. So they will sanction an additional withdrawal of fund over and above your zero value in your current account. For example, let's say I approach a bank, and I have been running this business for a number of years, and I have been year on year, my there is a good growth, and my financial statements reflect the healthy state of my business affairs. And now I approach, because I need to now expand my business, so I approach the banker for an overdraft facility. Right? So the banker says fine. So based on various investigation of my financial statement and other requirements or the norms by the bank, they say okay, fine, we will give you an additional overdraft facility of 5 lakh rupees. That means I can now start issuing money to anybody, or I can withdraw money over and above my zero value of balance till I reach a additional withdrawal of 5 lakh rupees. So that's basically the overdraft limit that the banks allow. right? Now this particular limit which the bank sanctions, okay, I will keep continuing as long as I'm performing as per the expectations of the bank, right? So the bank is not going to tell that you repay that money or whatever, to the extent up to the extent that has been sanctioned of 5 lakh rupees, whatever excess money that I have withdrawn, at no point in time in a normal situation the banker is not going to ask you to pay back that money. So which means now this is a long term loan which you enjoy this benefit as and when you require over a period of financial years. Now, probably in the upcoming years, in case your credibility is much better, your business is performing better, and you want to further expand, probably you can apply for an extension of overdraft facility. Again, bankers will consider, and probably they might extend or they might not extend your overdraft facility depending on your results of your operation. But what the point that I'm trying to make here is that these are the loans and borrowings which are which the benefit you will be enjoying as long as you're running your business in a normal way without any damage to your business operation, right? So the differentiation between a term loan is that you pay on a periodic basis, and then at the end of the term period the loan is getting paid off or the loan gets cleared. In case of a OD account, you continue enjoying the benefit. Now, what is this OCC account? Now, OCC stands for, like I mentioned earlier, open cash credit. Now, what is the difference between OD and OCC? So, the criteria that is applied for sanctioning these overdraft or OCC more or less is the same thing. But what is the difference between OD and OCC? So in the open cash credit, what happens? The amount of overdraft or the amount of money that you can overdraw depends on certain condition. Now, in case of an overdraft, there is no uh, conditions which is going to satisfy. It's a blanket approval of 5 lakh rupees that you can enjoy as a overdraft facility. Now, in case of a OCC, there are two very important information that generally the business need to provide to the banker on an ongoing basis, and based on the value of the information that you are providing, the facility of overdrawing money depends on the value of the information. So what is that information that you need to produce on an ongoing basis? In case of a OCC account, generally you have to submit your stock statement on a monthly basis, and also your outstanding receivable. That means all this money that you have to receive from your sundry debtors, and what is the stock, the unsold stock or the closing stock that is lying within your organization at the end of the month. So every month, by generally by 5th or by 7th or by 10th of the subsequent month, you are supposed to produce these two very important statement to the banker. Now, based on the amount of stock that you are holding or the amount of money that you are supposed to receive from your sundry debtors, the total of the amount of stock and the money receivable will be considered, and a percentage of that outstanding money or the value of inventory that you are holding determines your withdrawal or the drawing facility of amount to that extent. Let me give an example. Let us say I enjoy a OCC facility in the organization. Sorry, I enjoy the OCC facility from the bank, and I have to now produce my inventory report or my stock statement I have to produce, and also my outstanding receivables. So in my company, let's say as on this particular month, my stock that I'm holding, the unsold stock that I'm holding in my business, is say about 5 lakh rupees, and the amount that I'm supposed to receive from my customers as on date is 5 lakh rupees. So the total value of my stock and receivable, because both are my asset. So we will discuss that when we get into the asset part of it. So both of them are my asset. So now 10 lakh is the value of my asset that belongs to me. So based on this 10 lakh, probably banker will say that 60% of this or 70, I'm just giving an example, 60% of this or 70% of this is what is the credit facility that you can enjoy for the upcoming month until you produce your statement of your inventory and receivables in the subsequent month. So in case of a OCC, what happens is the limit could vary depending on the value of your asset that you are going to declare to the banker month on month, right? So again, if you see, this is not going to get closed until and unless your business is getting closed or you are in a bad situation. Then probably the banker could call back on these facilities that they have offered to you, and they might be asking you to close the uh, facility, the close the overdraft and close the OCC account, right? So this again is a longer period of time which keeps continuing as long as you're running your business, right? The third one, current asset, we said is that generally you'll have to clear off within 12 months period. So let us see what are those things. So the first one we saw is the short term debts. That means any debt that you have to pay back in a shorter period of time. Now these debts could also be some of the temporary additional facilities or loans that you have taken for your business, which needs to be paid off within a specified period of time, 3 months, 6 months, or 9 months time. So those are classified because these are not going to be a enduring or continuing loan benefit that you are going to enjoy. So that is why these kind of loans, you classify them under your current liability, so that like you have better clarity over the liability that are there in your organization. The short term debt could also be monies that you borrow from your friends, relatives, or in case of a group company, probably sometimes you would have borrowed money from your sister concern, which needs to be cleared off at an earlier point in time. So the short term debt is one part of your current liability. And then and then you have the trade payables. Trade payables are nothing but your sundry creditors. So all those money that you have to pay to your supplier, uh, where you have purchased goods on a credit basis. So there is a defined period of time within which you are expected to clear that liability to your vendor. So generally, credit term can run between 30 days to 180 days max, right? So those are some of those liabilities which you need to clear off that. And then comes your tax dues. Okay, the tax dues are those amount of tax that you have collected on your sales, right? And our indirect tax system basically is a value added system of tax mechanism, where we basically pay only the tax that I collect on the value addition, right? So whatever tax that I paid on purchase of those goods, which I've already paid my supplier. So that is basically, we call that as input tax credit. And whatever is the tax that I'm collecting with my customer, I am going to reduce the amount of tax that I've already paid my supplier, and the excess amount of tax that is lying after reducing my tax that I've already paid to my supplier is what I'm supposed to pay to the government, right? So these are paid on a periodic basis, right? So generally, it is paid on a monthly basis to the government. So those are your liability, which you have to clear them off. And again, if you see, these are falling a liability which needs to be cleared in a shorter period of time. Okay. And then comes your expenses payable. Now, if you could recollect in our business processes, we had discussed about one of the business transaction or the accounting transactions that you should make is the provisional entries, right? So those are the liabilities. So I had explained in the previous section where we I had explained about what is this provision and how these provisions are going to be treated and how are you going to account for these provisions, right? So probably if you people have not, some of you have not seen my previous video, kindly look into my previous video where I have explained about what is this provision all about, and along with the examples. So the provisions are nothing but your expenses payable. Examples of expenses payable are your salary payable, rent payable, maybe electricity and water charges payable, maybe telephone bills or mobile bills payable, right? So these are your payables, which are again shorter period in time where you have to make the payment, right? So broadly, if you see, I'm not again getting into the advanced reporting because deliberately the entire session of mine I'm going to keep at a basic or at the intermediate level, so that I mean, like, it helps people to just kickstart with a confident mindset when people are going to get into the world of accounts. So I'm again covering only at the top level or at the basic level, right? So now if you see, our liabilities are broken down into three clusters. Okay, so the first one, it says equity and capital. The second one, it talks about loans and borrowings. And the third basket is your current liability. By looking at this, you would have got a fair idea of how your liabilities are represented. Like I said, capital is the last obligation you need to pay. Long term liabilities are the next obligation the company needs to clear off. And current liability is the most critical one, and that is where most important care needs to be taken so that you are able to meet this commitment within the prescribed time. For example, taxes due. Now, if you don't pay the taxes that you have collected within the specified period, then you will end up paying penalties, interest, and a lot of other complications are there. At the same time, if you don't pay your supplier within the prescribed credit period that they have allowed to you, you will end up in trouble. Probably, again, I had discussed about the implications of not paying your vendors on time. What is the implication in my previous session, right? So if you see, these are getting represented in a logical manner, and this type of representation of your liability is basically called as the order of liquidity, right? So what do we understand, or what does it mean, the order of liquidity? The faster liquid liabilities are reported at the bottom of your liability side of the balance sheet, and the longer time liability are reported at the top of your balance sheet. So for anybody, right, when they are looking at the balance sheet, see, the most concerned part is the current liability, right? So this is where basically your current liability, and when we get into the balance sheet of the asset side, we will also talk about current asset and how this current asset and current liability impacts the business's working capital. Also, we will see at a later point in time, right? So I hope again the liabilities section of the balance sheet gives you more clarity on how these liabilities are represented and what is the objective behind representing these liabilities in this order, so that we are more clearer about it, right? So in the next session, we will discuss about the asset side of the balance sheet. In the similar way, we will try and understand what are the classifications that they are done, that is done at the broader level on the asset side. What implication does it have, and how does it give information to the person who is looking into the asset side of your balance sheet, right? So thank you once again, all of you, for staying till the end. As usual, if you have not subscribed, kindly subscribe. If you like it, kindly share it. Thank you very much. Until we meet in our next session. Thank you.